then we'll have a break. Okay.
Okay, sir.
So the topic is mutual funds. Okay, fine. So basically, we have gone through and understood, how to find out a good company in terms of, how to evaluate a company, which company is better to buy. Okay. Now, instead of buying directly into equities, we can always buy mutual funds where, we leave it on the fund managers to decide, which companies are going to do better and which are going to offer more returns. Okay. So this is yet another way of investing your money. Okay. And Akriti, can you read this?
Yes, sir. A mutual fund is a type of investment vehicle that pools money from multiple investors to purchase a diversified portfolio of securities such as stocks, bonds, money market instruments, and other assets.
So basically, a mutual fund we all know is that, it pools money from various investors and they buy, the mutual fund, companies, they buy, either stocks or, bonds or money market instruments, or even future and options products. And they earn something out of it and then share with the investors, the unit holders, basically. The shareholders here are called unit holders. So we'll talk about that. Just read this.
The fund is managed by professional fund managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors.
So when you buy mutual funds instead of directly investing into stocks, the other way is that you can put your money into mutual funds and they are managed by professionals. So you don't have to bother about which stock is going to do better. So that you leave the job on the fund managers who are professionals who are doing a lot of research. So they try to generate capital gains. That means there is a capital appreciation which you earn over the time and which is reflected into the price of the units of which you have purchased, and then it can even give you some dividend, which is a recurring income. Okay. Okay. Just read this.
Mutual fund is a trust that pools the savings of several investors, invests these into different kinds of securities, shares, debentures, money market instruments, or a combination of these. Income thus generated and the capital appreciation is distributed among unit holders in proportion to the assets held by them.
Okay. Now it is a trust. Now it's a very important word that it is a trust. When people ask, when I'm giving money to the mutual fund, is it safe? Now it is a kind of a trust. It is registered as a trust in India. All the mutual funds, they are registered as a trust. So there are going to be some trustees. So it is, all the money which the trust is going to earn belongs to the beneficiaries, like the persons who have invested in those mutual fund schemes. So it is actually a form of trust. So we'll understand more about what does it mean in my coming slides. So then the same thing, that it is going to invest into all kinds of securities, and then whatever income which is generated is going to be shared among all the unit holders in the proportion of to the numbers of units which they hold. Okay. Now, if you see this chart, the process starts from the top. Investors, the monies, they pool their money with the fund manager. He's going to invest into securities and generate returns, which is again passed back to the investors. Okay, so that's the whole process of a mutual fund house. What they do is, this has been explained here. Okay, now here are some of the key characteristics. So I'm just going to just not read all of it. So the first is diversification. Okay, that means if you put your money is put into various kinds of securities in different proportions. So you get the benefit of diversification here. Then it is managed by professional management. So there are people who are doing research, and they conduct research and they invest into only good stocks which are going to grow in future. So the advantage is that first you have advantage of diversification. Your money is not just concentrated in few stocks, which you try to do when you do it yourself, and then it is managed by professionals. Second, there's a liquidity. So whenever you need money, you can always redeem the mutual funds and get your money back from the fund house. Okay, because they are not listed. Most of them are not listed in the stock exchange. So it is they're redeemed. Okay, that means you go to the fund manager and you say that I want my money. So you will immediately get your money in the next second day, third day, T plus 2, you receive your money. Then affordability. Now you can always invest like 1,000 rupees per month or 2,000 rupees per month. You can make a SIP basically, which is called systematic investment plan, or you can always keep buying in a small amounts. Okay, you can't do that if you want to buy stocks. So you have to at least a big amount of money to buy some meaningful amount of stocks. Okay, So now just read this, Akriti.
Benefits of mutual funds. Which stocks should I invest in? Mutual funds are run by professional managers who have necessary skills for stock selection. How many shares can I really buy with rupees 1000? To achieve diversification, let's say there are 1000 investors who invest 1000 rupees with a fund. The total amount with fund will be rupees 10 lakh. They can now achieve the diversification by purchasing number of shares across various sectors.
So what they'll do now, you have given the money. There are about, thousand, how much? Thousand investors are there, and everyone has given $1,000. So the mutual fund scheme has 10 lakh rupees with it. Okay, so they are going to suppose hypothetically, let's think that they are going to invest in three stocks. Okay, SDFC Bank, Reliance, and Infosys. Now the share price which I'm given is, is not, I mean, sync with the current reality. It was, made about few years back. So SGFC, the fund bought 250 shares at the price of 1600 rupees. So that means out of 10 lakhs, they invested 4 lakhs rupees in SGFC. Reliance, which was trading at 3000 rupees earlier, so they bought 100 shares. So that means 3 lakh rupees was invested in Reliance. Infosys, they bought 200 shares. The share price was 1500 at the time of investing. So it also got 3 lakhs. So total, your 10 lakh rupees of all the investors that are invested into three companies. Now, how much of this you hold on pro rata basis? Suppose you have bought 1000, you have invested 1000 rupees, okay? So you have 0.25 shares of HDFC, zero point 0.1 share of Reliance, and 0.2 share of Infosys, which you can't do yourself. Okay, you can't buy 0.25 share of SDFC, and with 1000 rupees, you can't have diversification into three companies. Okay, so that's a the explanation that you can have a good diversification with a very small amount of money itself. So if you could have to achieve this of your own, you have to buy at least minimum one share of each case, and then the amount will go up to a large amount. So it will be around 5 to 6,000 rupees. You have to invest to cover up this diversification. Is it clear, Akriti, Ritesh?
Yes, sir.
Okay. Now, what are the types of mutual funds? So just read this.
Types of mutual funds. First is equity funds. Invest primarily in stocks and aim for capital growth. Second is bond funds. Invest in bonds and aim for income generation. Money market funds invest in short-term, high-quality investments issued by government and corporate entities. Balanced or hybrid funds invest in a mix of equities and bonds to achieve a balance of income and capital growth. Index funds aim to replicate the performance of a specific index, such as the Nifty 50. Sector funds focus on the specific sectors of
Now, we will be studying more in detail about, types of mutual funds, but they are primarily investing into equity markets, equity stocks, okay, and bonds, where, I mean, when you invest into bonds, you get interest, okay. So it can be either bonds or equity, or the money can be invested into money market instruments. Like, have you studied what are money market instruments ever? Do you know some money market instruments like treasury bills, CPs, commercial paper, certificate of deposits, or treasury bills? Have you ever studied about them in your course?
So we have heard about them, but not particularly studied in detail about them.
Okay. So, that there are some money market instruments. They are short-term money market instruments. Whenever, a company or even a government needs money for a very short-term purpose, like for, for 6 months or for 3 months or for 5 months, so, or for less than 1 year, they raise money through money market instruments. Like, when the government needs money, they issue treasury bills. Okay. Because their period is about for 1 year. Okay, so they are bonds of 1 year bonds. Okay, they're called treasury bills. Then, if the company needs money, they issue commercial paper, and they are again tradable. Okay, so the commercial papers are basically, earlier what was happening, the companies were going to the bank and taking a working capital loan. Now, instead of doing that, the more recent and a better method is that you issue commercial papers for short-term commercial papers, and then you can raise money for say 90 days or for less than 1 year. Similarly, banks can raise money by issuing certificate of deposits. Okay, they're not like fixed deposit, but they're called certificate of deposits. They are short-term instruments. So we are going to talk about them. Now, these instruments are generally bought by mutual funds also. Okay, so when we are also exposed to these money market instruments as an investor, because we don't buy directly these money market instruments, but when we buy mutual funds, so they are investing into these instruments. So in fact, we are buying these mutual funds indirectly. Okay, we are buying these, money market instruments indirectly. Then there are hybrid balanced one, which is, equity and bond and money market all mix up. The mutual funds can invest into certain combinations, so they are called balanced funds. And then, even we can invest, into Nifty or a Sensex by investing into index funds. So we're going to talk about this more in detail. Then sectoral funds. Suppose if we think that the banks are going to do very well, or the financial sector is going to do the best in the next 3 years. So we buy those funds which are called sectoral funds. Though they are risky, if something happens to the sector, then we may lose a lot. But if you believe that next 2 or 3 years, the pharma sector is going to do well, but we don't know which company to buy, like Cipla or Sun Pharma. So we buy sectoral funds. Instead of taking a hit at one stock or, into equity, we can buy sectoral funds which invest into a particular sector. So whenever we are bullish on a sector, instead of buying, individual stock, we buy sectoral funds. Okay. Then, what are the key characteristics of mutual funds? Now we have to pay some fee or expenses. When mutual funds, they are run by, the fund houses, so they are going to charge a management expenses. Okay, just read this, Akriti.
Fees and expenses. Mutual funds charge fees for management and administrative expenses, which can include management fees, distribution fees, and other operational costs. These fees can affect the fund's overall returns. Then,
Okay, just hold on. So this we all know that, whenever we are going to invest our money into a mutual fund scheme, so we will be incurring certain expense. Okay, and that money is a management fees and administrative charges or distribution fees. So because we may tend to buy these mutual funds either directly from the asset management companies, that means directly the company which is issuing mutual funds, or go to our relationship manager or the bank and place an order to through those channels. So there we have to pay some commission. Okay. So all that money is our cost. Then second,
net asset value. The value of a mutual fund's asset divided by the number of units outstanding.
so
NAV is
uh,
usually calculated at the end of the year.
so every day, the fund, whichever mutual fund we are investing, so they are going to publish an NAV. At what price it is traded today. Now, most of the mutual funds, they start, when they start with 10 rupees. So it keeps going up or going down depending upon how the market is behaving. Okay. So on a particular day, what is the value of all the investments divided by, minus any kind of liabilities, divided by, the total number of units which the fund has issued. So we'll calculate the NAV, and we'll just know a formula. How do we calculate the NAV also? We'll do some example. And then the last one is diversification. As we know, the mutual funds are not going to invest into various companies. Okay, so a diversification is achieved. Then, the structure of mutual funds. So I'm going to come back here. Just read this, Akriti.
Mutual funds in India follow a three-tier structure.
Okay, so this is very important, and you must understand. Okay, fine. So it has a three-tier structure. The first is the sponsor. So any person who is going to start a mutual fund, he is called the sponsor or a promoter. Read this.
The creator of the mutual fund. Think of it like the parent company that proposes the formation of the fund. Needs to be approved by SEBI. Role sets up the trust and appoints the trustee.
So first is there has to be a promoter. Now, like for example, SDFC Limited, or a bank starts a mutual fund company called SDFC Mutual Fund. Or for example, State Bank of India started a company called SBI Mutual Fund. So SBI and SDFC, they are the promoters or the sponsors. So they are going to, get the approval from the SEBI, and they are going to start a trust. Okay. And appoint trustees. Okay. Because, they are going to collect money from the investors, and the money which they would have would be form of, a trust with them. Okay. Then the mutual fund entity. Okay, read this.
Trust mutual fund as an entity created by the sponsor through a trust deed under the Indian Trust Act 1882.
Okay, so the first thing is that they have to create a trust. Okay, so they have to make a trust deed and get it registered under the Indian Trust Act that they're going to start a mutual fund company. Okay, a mutual fund.
It is the actual mutual fund, the entity that holds investors' money.
So all of our money will now be going to that trust, okay, or the mutual fund. Okay, fine. It will have a name. Okay.
It is not for profit. The profit and losses from investment go to unit holders, investors.
So whatever the trust or the mutual fund scheme is going to earn, it belongs to the investors. So there will be no profit going to the promoters from here. Okay. So whatever the company is going to earn, it needs to be passed on to the investors. Okay.
Governed by a board of trustees or trustee company.
So it will have a board of trustees. Okay, and there will be a trustee company. Okay, fine.
They act as watchdogs, ensure that the AMC is managing funds in compliance with SEBI rules and the best interest of investors.
Now, what will happen is that the trustee or the trust will create a company, okay, and that company is called asset management company, okay. So they will float a company, okay, and that is going to manage the affairs of all this mutual fund, trust. So there's going to be a trust. They're going to be an asset management company. So asset management company is going to run those trust, okay, and okay, read further.
Cannot be the same people as the asset management company.
Okay, so I'll just explain. So what is an asset management company? Now, these companies are listed on the stock exchange. Okay, fine. So this is the investment manager. So that means the asset management company is going to invest those mutual funds, which are in form of trust. So they are appointed by whom? The trustees, which are approved by SEBI. So, they are going to be approved, they are going to be appointed by trustees, make all investment decisions, manages funds, handles operations, and they are registered under the Companies Act. Example, ICICI Prudential AMC, Nippon India AMC. Now, these are the companies, these are the front end companies, okay? Because we always see their names, asset management company. But at the back end, they have the trust, okay? So they are managing the money is collected by the trust, and the trustees appoint a company to look into where the money is going to be invested. So they are going to appoint investment managers, the team who is going to manage the all the money which they have collected, where they are going to invest. They are going to carry out the research, and they are going to put the money into various companies so that they can get kind of a good profit for the unit holders. Okay. So then the last one is called the custodian. Okay. Read this.
Custodian, a SEBI registered entity responsible for holding the securities and assets of the mutual fund securely, independent of the asset management company and trustee.
So the last in line is called the custodian, who is going to keep a custody of all the assets of the company. Now, the company is going to buy, or the trust is going to buy, shares, bonds, everything. So somebody has to keep an account of that. So he's called the custodian. If you look at the chart on the right, which will explain to you, the top is called the sponsor. Then he creates a trust, and they appoint the trustee of the trust. Now the trustees give the job to AMC, which is a company which is listed on the stock exchange, and at the same time trustees are going to appoint a custodian who is going to keep about the custody of those assets of the company. Okay. Then the AMC is going to appoint various people like distributor agents who are going to sell the schemes. Like whenever we want a fund particular we want to invest, so we can go to the agents or the distributors and buy a fund from those distributors. Okay, or the bankers. For example, bankers are going to keep. Now all the companies will have a banker where all the money. They're going to receive dividends or receive interest on bonds. So money is going to come to the bankers. So there has to be a bankers, as any company will have a banker. Then register R&T agents. Okay, so these are the people who are looking after, like some people may be, redeeming, some people will be buying new. So somebody has to keep a, registrar kind of a person who is going to keep about the track of who are the unit holders, who are the new unit holders who have gone out, who have sold their units, and they are no more the unit holders. The new units are coming. So somebody is going to keep a track, like the shareholders, like of the company, because the shareholders will keep buying and selling the stocks. So somebody has to keep a track of that. So they are called R&T agents. Okay. Now it is like this, the flow. The sponsor, just read this. Sponsors creates a trust, appoints trustees, trustees appoint AMC, and asset management funds invest. AMC manages funds, investors buy units, custodian hold the asset. Just look at this chart and you'll understand what is the structure of any mutual fund. And please ask me any question if you have not followed. First of all, they're going to be a sponsor who is going to create a trust. Okay. Then they are going to appoint trustees. Then the trustees will appoint an asset management company, okay, which will be a listed company, listed under the stock exchange as Companies Act, okay, and they are going to manage the funds of these mutual funds, and they are going to advise where the money is going to be invested. So they will be having a chief investment officer and his team who is going to carry out the research and see that the fund is producing a lot of returns for the unit holders. There has to be someone who is going to be the custodian who will be holding all the assets. Is that okay? Like, just look at the structure here. Look at this. The sponsor. Sponsor is whom? HDFC Bank. Okay. So the HDFC Bank started a mutual fund company. They created an asset management company. The AMC raises money from the investors and invests into group of assets. And the company which is formed is called HDFC Mutual Fund. Okay. Is it clear somewhat?
Yes, sir.
Okay. Now, these are the various asset management companies in India. Mostly the most important one, like ICICI Prudential. They are all listed companies. Okay, fine. They are managing. They are appointed by the trustees of a mutual fund, and the mutual fund is nothing but a trust, which keeps which keeps all the money of the unit holders. Okay, and now these asset management companies, they get their money from their income from the trustees, because the trustees are going to collect some money from us in form of every time we invest our money in a mutual fund, we have to pay some charges. Okay, so those charges become the income of those asset management companies, and on the basis of those charges, these companies will become how profitable or not, depending upon what kind of expenses they are incurring. Okay, so these are the asset management companies. Okay, now what do mutual funds invest in? Now, where the money is invested? It is invested in money market instruments. Now, look at this chart. This chart talks about the risk and the return. If you look at the right, extreme right, the most risky is the equity, where there's the highest return, okay, and the highest risk. Now, if you come at the left hand side, the money market instrument, the least risky, then the government securities, then a AAA debt. The companies which are given a AAA rating, they will be their returns will be higher. Okay, the risk will also go up. Then low rated debt. All the companies which is having double A, single A, or triple B rating, so they will give you a higher return. Okay, fine, and the risk will also go up. And equity has the highest risk and the highest return. So this letter talks about what kind of money and where it is put in terms of both return and risk. Is it clear?
Yes, sir.
Okay. Then we come to how the NAV is calculated. So NAV is nothing but the total assets minus the total liabilities divided by the total number of outstanding shares or the units. Okay. Now, uh, just read this.
The price of each unit is known as net asset value of the fund. NAV on any day reflects the value of the fund's investment divided by the number of units issued by the fund.
Okay. Read this.
Customers' purchase and sales price per unit is based on this amount.
Now, because every day the NAV is published. Okay. So if I'm selling or I'm buying, I have to pay this price. This is just like a share price. Okay. Fine. So let's, understand this. Yeah.
NAV is published on every business day for all funds. For liquid funds, NAV is published on Sunday calendar. In equity funds, returns come mostly from price movement. Hence, the differential in NAV between two dates is mostly the difference in market value of the investments. In debt funds, returns come mostly from interest accrual. Hence, the differential in NAV between two dates is mostly the accrual, provided the period is sufficiently long to absorb short-term volatility.
Now, whenever we are investing into mutual funds, so these mutual funds tends to publish, their NAV in the evening around 9 o'clock, 10 o'clock. All these NAVs are published every day. Okay. And because the money can be invested into stocks, the money can be invested into bonds or the money market instruments. So if they are invested into stocks, so any price changing which is happening in the stock exchange, it will get reflected in the NAV in the evening. So when you compare the 2 days NAV, you will find the market has gone up, the NAV of a particular scheme will also go up. If the market goes down, normally the NAV will go down on that day. Okay. Similarly, for debt funds, it is like accrual basis. Like suppose I have invested into a debt fund where they have invested, say, a kind of a on any bond which is giving, suppose for example, 12% return. So that means every 1 month I'm going to get 1% return. So every day the NAV is going to be calculated based on what kind of a return it will translate it for a per day. Okay, so we'll do some examples so you'll understand that. Okay. Okay, so I'm just skipping this at the moment. So we'll come that little later. Okay, just read this.
XYZ Investments launches a equity fund. It raises rupees 150 crores by issuing 15 crores units of fund at rupees 10 each. Post-issue, investors can buy and sell from the fund. Suppose on a particular day, the number of units outstanding were 15.5 crores. The market value on the investments, including cash, was rupees 178.25 crore. The dividend income accrued was rupees 1.5 crores and expenses accrued total rupees 3.25 crore. What is the NAV of each unit?
Okay, so we have to calculate the NAV of the unit. Okay, so NAV of the unit, I think I have just given a formula here. If I have not, okay, so I think I have not given the the formula was here. Okay, so NAV is what? The fund assets minus the fund liabilities upon the total number of outstanding shares. Okay, fine. So we'll use this formula to calculate. Okay, here this is a company which has launched the equity fund. So it raises 150 crores by issuing 15 crore units of 10 each. So that means how many unit holders are there? 15 crore units. Okay. Now the post issue investors can buy and sell from the fund. Suppose on a particular day the number of units outstanding was 15.5, because now people can keep buying into these because these are called open-ended funds. So people can buy every day or sell also. So on a particular day there are 15.5 crores unit holders. The market value of all the investments including cash was 178.25 crores. Okay, so it started with 150 crores and today the value is how much? 178.25. The dividend income accrued, that means the dividend has been declared by the company, but it is going to yet not been added to 178, which is 1.5. This is income accrued, declared but not still received by the company, and expenses which the company has incurred but still not paid, that is 3.2. So what is the NAV? So we'll do like this. Is it okay?
Yes, sir.
So is it does it require any explanation? No.
No, sir.
Okay. So now just do this yourself. Just calculate and let me know.
So it's coming out 12.1.
12.1. Okay. Fine. So NAV, just look at the bottom. It's 12.1. Isn't okay? Fine. So fine. This also I'll just cover up later. Now we come to loads and commissions. Just read this.
Loans and commissions. Entry loan and surrender loan. Entry loan or surrender loan is the commission paid by the investor on buying the fund. Entry loan abolished Act 7.
So the entry load has been abolished. So earlier, when we were buying mutual funds, we were supposed to pay 2.25% as entry load. Okay. So that was, brought to zero now by SEBI about, 10 years back. So, or maybe 8 years back, we were paying 2.25. So when I started investing in mutual funds, so if I invest 100 rupees, I will be in fact putting almost like 97 rupees 75 paisa will be invested into stock market. The rest will 2% will go to the fund manager as his income. Okay. And then again.
Exit or back-end load. Exit or back-end load is the commission paid while redeeming the units exiting from the fund.
So whenever there are some funds, because now the entry load has been abolished totally. So the exit load is still there, That means if you invest into certain mutual funds and you redeem it, so you have to pay some kind of an exit load. Okay. Now, if you hold it for a long period, normally the fund house doesn't charge the exit load. But if you are going to invest for a very short period of time, so 1 month, 2 months, 3 months, then you have to pay an exit load. So each scheme will have a different kind of exit load depending upon the period. Okay. So you have to, look at the scheme and understand what kind of an exit load they are charging before you exit. Okay. Then
Trail commission. Distributor also receives some trail commission from asset management company. This is paid based on net assets of the investors during the period.
now, whenever we are investing through a distributor, now there are two ways through which you can invest into mutual fund. One is you go directly to the AMC site and buy it online. Registered on the site, give your PAN number and a bank account number and buy it directly. Then you don't have to pay a trail commission. If you are buying it through a distributor, normally most of the people, they buy through a distributor. Okay. Now, some commission is paid to them, which may vary between 0.5% to 1%. Okay, per annum. So if you hold, whenever you buy, you have to going to pay that kind of a commission. So it is always advisable to buy directly rather than through a distributor. Okay.
Trail commission varies between equity and debt. In equity mutual funds, it can range from 2.5%.
So have you all invested any time, Akriti, Ritesh, Abdul, into mutual funds? Acha. So have you invested directly or through direct? Directly. You have to buy through. Most of them usually, the young people always buy directly. So it translates into, I'll just show you, when I go and see those mutual funds, how much they are charging. So I'll show you that the trail commission, how much money is going to the trail commission to them. Okay. Read this.
For debt fund investments, this commission can be between 0.1 to 1%. The trailing commission is calculated as a percentage of the entire investment brought to a fund by a particular intermediary.
So that means if you're going to buy through a intermediary or a distributor, you have to pay the trail commission. Okay. Now these are certain charges. They are the annual charges. These are called this is called the TER, which is the total expense ratio. When you give the money to the mutual fund house, they are going to do a lot of research and put your money. So they have fund managers, they have people who are working, they are traveling, they have an office, so they have to incur a lot of expenses. So this is an annual kind of a charge which they are going to charge. Now this is governed by SEBI. Now an asset management company which owns about 500 crores up to 400 crores of a fund, they can charge 2.25% annually. A debt fund, it will be 2%. So on the next 250, suppose as the asset management, as the amount grows, the fund grows. So it is, and then the next 250 is going to be 2%. So as the fund becomes bigger and bigger, it goes down as low as 1.05%. For an equity fund, for a debt fund, it is 0.8%. So this is the kind of a expense, which is a limit, which the fund house can charge from the investors. Is it okay?
Yes, sir.
Okay. Now, the mutual funds in India, can be classified based on various structures. Okay. So, first is called the structure. Second is investment objective. Then the plan. So, let's talk about the structure. Now, the mutual funds can be either open-ended funds or closed-ended funds. So, when you can buy the fund on any particular day or sell anytime you want, they are open-ended. But the closed-ended funds, they open, they start the scheme and then they get closed down. So they are available, they can give you money after 3 years or 5 years. So that means they collect the money and for 3 years and they close the fund and then they generate the returns and give the money back to you after the close of the fund. Okay. So open-ended funds, just read this.
Open-ended mutual funds are a type of investment fund that does not have restrictions on the amount of units the fund can issue. These funds are continually open to new investments and redemptions, which means investors can buy and sell units directly from the fund at any time. The price of the unit is determined by the net asset value of the fund, which is calculated at the end of each trading day based on the total value of the fund's assets minus its liabilities.
Okay, now almost like 90% of the funds, they are open-ended. Okay, or 95%, where on any given day, I can buy those mutual funds at a particular NAV. Okay. And I can even redeem them after some time. Okay. So the NAV is calculated every day and it's published at the end of the day. Okay. Fine. And the close-ended funds, just read it.
The fund is open for subscription only once, and the corpus is fixed once the issue closes. Thereafter, they can buy or sell the units of the scheme on the stock exchanges where the units are listed. A close-ended fund are non-redeemable, that is, investors cannot buy or sell into the fund. They have a stipulated maturity period. Investors cannot transact daily.
So there are certain kinds of funds, like certain kinds of schemes which are open, okay, and then they collect the money, and those funds closes the scheme. That means they are there for 3 years or 5 years. So you'll get your money only after the period is over. Okay, you can now, since you can't redeem them, so they need to be listed on the stock exchange. Okay, so you can go to the stock exchange and you can sell those and get your money, but you can't get the money from the mutual fund house. Okay, so these schemes are generally listed on the stock exchange. So this is as per the SEBI requirement. If a company is issuing close-ended funds, so they have to give a way out to the investors. If they want their money, they can go and sell those units which are listed on the stock exchange. Okay, read further.
In order to provide an exit route to investors, give an option of selling back the units to the mutual fund through periodic repurchase at net asset value related prices. SEBI regulations stipulate that at least one of the two exit routes is provided to the investor, that is either repurchase facility or through listing on stock exchanges. These mutual fund schemes disclose net asset value generally on weekly basis.
Now, the SEBI says if you have collected the money through a close-ended fund, then there should be two ways how the investors can exit. One would be that they are listed on the stock exchange. If you don't want to get it listed, then after a certain period of time, say after 1 year or 2 year, you can make those funds open for a particular week or 10 days so that anybody needs money, he can go and redeem his fund. So any one of the two may be opted by the company. If the company says that we are not going to give the money, only money after 3 years or 2 years after the scheme is closed, then those funds should be listed on the stock exchange. Okay, so that a person can always exit. Okay, so I'm just scared. Now this is very important. Okay, based on investment portfolio. So just read this.
Based on investment portfolio, equity schemes, debt schemes, hybrid schemes, solution-oriented schemes, and other schemes.
So there are five such categories. Now this category has been given by SEBI. Before the SEBI came into picture and formed these five heads, then they were, before that there were a lot of schemes with different kinds of themes. So now this was creating a lot of confusion among the investors. So the SEBI decided there are going to be only five categories. If a fund can invest into equity schemes, or a fund can invest into debt schemes, or a mix of equity or debt, which is called hybrid, or it can be solution oriented, like a retirement planning fund where you can put your money for planning a retirement, or child education like this. So they can be a solution oriented. Others would be where suppose I want to invest say into say international equities. Okay, so there is a fund which is going to invest the money into international funds, so I can be exposed to Microsoft, Apple, and there can be some other categories also, if you are going to learn that. Okay, so that the last one is called the other one. Okay, so just read this.
Categories of equity mutual funds as per SEBI.
Okay, just read this, is a very important one.
SEBI defines large cap, mid cap first, top
Companies.
100, top 100 companies in terms of market capitalization, to top 20 industrial segment, and those 400 to 250 companies credit card, to 130 first company, and those in terms of market cap at 30 lakh.
Okay, now this is the definition of large cap, mid cap, and small cap. So there are about a lot of companies in India which are listed in the stock exchange. The top 100 companies in terms of market cap will be called large cap as per SEBI. And from 101st to 250 companies will be called mid caps, and 251st company onwards will be called small caps. Okay, so what I've done is I've just given a Excel sheet. Okay, just open that Excel sheet in the morning. Average market cap. Can you open that on your
Yes.
laptop? So this is, you can go to the Google, and every 6 months the company's listing is given. Every month this figure is published. Okay, so if you look at this, what I've done, I have just copied from that site and then put it in an Excel sheet. Okay, so this is the top 100 companies of India. Okay, if you go, the list will go up to 100. Okay, so this list will keep changing. Fine, this is the list which was prepared on a particular day on 30th of June 2024. So I couldn't find a list on 31st of December 2024, which would have been actually ideally been issued by now by the mutual fund, this thing by the SEBI, but it's not been yet published. Okay, fine. So if you go to for example, I'll just show you how to trace it. Uh, so go to your Google. Okay, and go to average. Just write average market capitalization. So there is a site called www.amfi Mutual Fund India. Okay, average market capitalization of all listed companies. So just press, you will get this list from there. Okay, fine. Are you seeing the list on your screen? Yes, sir. So this list is available, and if you can see, this list is published every 6 months. Okay, and I have just downloaded this and put it in an Excel sheet here. Okay, fine. So which is the biggest company in India, Ritesh, as per this list? I'm just hiding this because this is my own creation. Okay, so Reliance is the biggest company in India. The market cap is 19 lakh 47,000 crores on that day when it was captured. Okay, then the second, then we have the companies like this. Okay, fine. And which is the 100, the lowest, the larger cap company, the in terms of the large cap, which is the 100th company in India? Bosch Limited. What is the market cap? Let's go to the mid caps now. So which is the the highest mid cap company? बट एक बात है, अच्छा ये मैंने क्या कर दिया, मार्केट कैप को उल्टा कर दिया है। अच्छा इसको मैंने सॉर्ट कर दिया है, so I should be having the highest. Okay, so which is the biggest market cap in terms of mid cap company? Cummins India. Okay, which is the 101st company. Okay, fine. So what is the market cap of this company? Okay, can you find Vodafone Idea here? So which is this? Is this company mid cap or small cap or mid cap? Okay, then SRF? Mid cap. So now SRF was coming into top 100 few months back. Now it is coming into the mid cap. Okay, so now we come to the small caps. Okay, so small cap will start from which number? 251. 251 onwards. So which is the biggest small cap? API Limited. And the second one? Tata Chemicals. And then this list is very long. Okay, this list is if you go down, it will go up to a very small amount, so we're not going to that. Okay, so this is the total list. Okay, so now what you have to do is that you have to open the main thing. Okay, open the Google and open this. Are you able to see this site? हाँ, money control में मैंने I have given the link. Okay, on the WhatsApp. Just open that. Okay, sir. Just 10 minutes more and then we will have a break. Okay, 3:15 we are going to open. हो गया? Now look at this. We have 5 categories: equity, hybrid, debt, solution oriented, and others. Are you seeing that? Yes, sir. Now, within equity, we have so many categories. Just read out all of them.
Mutual cap, multi-cap fund, small cap fund, contra fund, large cap fund, ELSS, focus fund, large and mid cap fund, dividend yield fund, value fund, mid cap fund, sectoral thematic, and flexi cap.
So there are 11 categories of equity related mutual funds. Okay. Then we have hybrid debt. We'll go later. So we have 11 categories. Okay. So I'm just pulling it down for a while and open my slide again. So the first one is called the large cap. Okay. Just read this large cap.
Large cap fund invest predominantly in large cap stocks, that is the 100 companies that are right at the end. Its objective is to stability and stability returns. Risk is moderate, needed for conservative investors willing to invest in volatility.
So just read the top one. Equity fund invest a minimum of, yeah.
Equity funds invest a minimum of 65% of their total assets in relatively rated instruments.
Okay, so that means the minimum money to be invested in is in equity. Okay, so the large cap, they are going to invest into the top 100 companies of India. Objective is stability and steady returns. Risk is moderate because they are the top 100 companies of India, so risk is less. So if you are a conservative equity investor looking for less volatility, then invest into large cap. Okay, so you choose a large cap fund and say, this is what I'm going to put money. I don't want to take much risk, though I want to take risk, but not a big risk. But if you want to take little risk, then where you're going to go? To the mid cap. Read this.
So the top is
नहीं टॉप को छोड़ दो नीचे आ जाओ मिड कैप से चलो
invest minimum 65% in mid-cap stocks. Companies rank 101 to 250 by market cap. Objective, higher growth potential. Risk is high. Ideal for investors with a higher risk appetite and longer investment horizon.
So now here they are going to invest your money into the next uh, from 100 first to 250 companies. Okay, mid cap. Higher growth because these companies are tend to grow at a higher rate. If you look at the the growth rate of the large caps, it ranges from 12 to 14% over a long term 10-year horizon. Whereas a mid cap is going to grow at around 18 to 22%. We'll see that. Okay, we'll just see when I'm talking the figure. We'll just see when you go to the money control. So here you get a higher growth, but the risk also goes up. Ideal with higher risk appetite and longer investment horizon. So you should have a long-term horizon. Okay, you should have a higher risk appetite. The return will be also higher. Then the last one, I mean, before we go to the other ones, is called the small cap. Just read this.
Invest minimum 65% in small cap stocks. Companies rank 251 and beyond. Objective, aggressive growth. Risk is very high. Ideal for seasoned investors willing to take high volatility for higher returns.
Now here the risk is the highest. Over the last 10 years, these funds have given almost like 25% return, but with lot of volatility because they are going to invest into those companies which are beyond 251 or more. Okay, so here the growth is going to be aggressive because these companies tend to grow at a higher rate, but there is a lot of risk because the small companies can even become bankrupt or become you are risking your money by putting your money in small companies. So only the people who are seasoned, who are going to take a willing to take higher volatility, that means higher risk, but you're getting higher returns. So let's come back to the money control and then we'll talk about the other ones. यहाँ आ गया?
Yes, sir.
Okay, now we do a practical exercise. So first is called the returns. Okay, and we just choose large cap. First, choose the large cap. Have you?
Yes, sir.
Then go if choose returns. Okay, choose them.
Yes, sir.
Then uh, you will come to here. So these are direct plans, these are regular plans. Choose direct plans. Okay, then download data and just download this on your desktop. And there will be a file which will be created which will call historical. returns. Okay, so let me just okay, so you will have this file, isn't it? Okay, now what you do is just delete the first row. इसको delete कर दिया? Then delete the B column and C column. So this is direct plan and large cap. So we all know that they are all direct, they are all large. So we don't need this information. Okay, delete this. And on the sheet number 1, you call it large cap. इसका नाम दे दो large cap. Okay, done. Then the second fund is called Semco large cap fund. There is no data. Okay. So just delete this because this is not having any data. So maybe I don't know why, but there is no data here. So we are deleting this. Okay. Done.
Yes, sir.
Now just shade everything. Shade from this place till 10 years. Okay. And shade the entire up to the last 33. And say Control T. And make my table has headers. So right click it and say OK. Done. And change the color you want, which you think is better for you. Change this color. Itna ho gaya?
Yes, sir.
Then now we have the schemes, we have the ratings, AMC. Now first is that you want, now these are all the schemes. Okay, fine. So there are how many schemes under this large cap? Today we have 33 schemes. So these are all mutual fund schemes where the money has been invested into various schemes. Now, if you want to invest only in 5-star funds, okay, so now you want that you should be putting, now there will be some funds which are no rating, so put them 0, 0, okay, and then again sort them. So you'll have only, so which is the top company which is having the 5-star, so DSP top 100 equity fund. So which has the highest rating, Chrysler rating of 5, okay, followed by BNB Paribas, then Nippon India, isn't it? Then we have 4 rating, 3 ratings, and there will be some funds which don't have rating at all, isn't it?
Yes, sir.
Now, some people they'll go by rating, okay. Some people go by AMC. That means how much money has been invested, which is the most popular, scheme where the lot of people have put money. So, which is the biggest company or mutual fund scheme where a lot of money has been put? ICICI Prudential. How much money they have got for the investors? 60,000 crores. Okay. Then followed by asset under management. So that means, if I put my money, now the money has been, it is all the money of all the investors and growing every day. Okay. As the stock market goes up, AMU will also go up. As the new people will buy more units, the AMU will go up. So the AMU will go up because of more people buying it, and the AMU increasing because the stock market is going up. The large tech companies are gaining ground and they are giving higher and higher. Okay.
Okay.
Okay. Now, as per my belief, the company which is having the largest AMU becomes very difficult to manage because more and more money, it requires a lot of research and analysis to grow it bigger and bigger. Okay, so there is one thought that you should not be putting money into the biggest AMU fund. Okay, but a lot of people tend to do that anyway. Then now these are the returns. Okay, now if you are putting money into equity market, so it's a long-term gain. Okay, so you should be looking for either 5-year or 10-year return. So just first go for 5-year, largest to smallest. Okay, and just put 0 wherever there is no return because there are some funds which are not as old as 5 years, so they're just coming at the top. So I'm just removing them. I'm just putting 0 so that I can again sort them up. So in terms of 5 years, which fund has given the maximum? And what is the return? And do this also for 10 years also. So here also you put 0. So do it for 5 year and 10 year. Of course, you can do it for all the years, but most of the companies will be having their schemes for up to 5 years. They will be as old as that. Okay. So now this chart is complete. Okay. As far as returns are concerned. Okay. So since you're putting your money for a long-term purpose, so the first thing is to look at how much return the fund has given for 10th year and for 5 years on an annual basis. So which company has given the highest return for up to 10 years or 5 years? It is, ICICI and Nippon, okay, and Canara Robeco. So if you have choose the top 5 mutual funds in terms of the return, it will be ICICI, Nippon, Canara, Mirai, Invesco, and Kotak, like this. Okay, the list will keep going. Okay, so this is the return which you can, if you have to, find out which is the best return company, then you choose this. But then you can always look at 1 year return also. Okay, let's see the 1 year return. So 1 year में भी आप इसको 0 कर दो और फिर यहां से देखो कि एक साल में सबसे ज्यादा फंड कौन ग्रो करा है 18%. Which fund? Motilal Oswal. Okay, so last 1 year it is Motilal Oswal which is done 18%. Now it is done 18. The rest of them have gone just 9, 5 or 4. So this is a kind of mystery how this company has grown given 19% return, whereas most of them are growing at a lower rate. Okay, fine. So this we need to explore. Okay, so this we can do some more analysis to find how the Motilal has given 18% return compared to the same category, which is hovering between 9 and most of them are giving 2%, 1%, because in the 1 year the return of Sensex is not that much. It's like 0.5% or 1%. Fine. And if you want to know what recently, which is the fund which is given the 6 months, so you can just sort it on the basis of 6 months. So 6 months, all the mutual funds have given negative returns, isn't it? The fund which has given the lowest is Quant Cap Fund. So you should always avoid these funds, which has fallen, too much in the last 6 months. Okay. So this tells you about the story. You have to just find out which fund is better. So ideally speaking, it should be, the rating plus the 5 year and the 10 year. So largest and the 10 year. Okay. So the fund which is you should be investing should be ICICI Prudential and Nippon. Is that okay?
Yes, sir.
And like for example, a Nippon fund, I have invested around to the tune of 1 crore rupees in the last 5 years. So I put most of my money in Nippon India large cap fund. Okay. Okay. So this is one. Okay. Now let's understand, like for example, it is ICICI Prudential or Nippon. Okay. So let's go back to money control, and then we just little bit, and then we are just planning to close it. Okay. Fine. We go to the site again. Okay. And then press here Nippon. Okay. And just select Nippon. Have you seen? Now, have you gone here, Nippon? Now we are going to understand, why Nippon has done so well, where all it has invested the money. Okay. So just 1 minute, and we are going for those. So there are two schemes: regular and direct. So what is the NAV of direct? How much?
90.06.
And if you look at the regular one, press regular and say go. If you would have bought this fund from a distributor, what would have been the NAV?
80.92.
So what does it mean that 80 81 था और अभी कितना है इसका डायरेक्ट कितना हो गया 90.
90.
So that means almost like 10 rupees has gone to the distributor. The 10 rupees has been taken by the distributor. Okay, during right from the inception of this fund 10 रुपया ट्रेल कमीशन में डिस्ट्रीब्यूटर की जेब में चला गया. अगर आपने डायरेक्ट खरीदा है तो आज 90 रुपए का. अगर आपने इसको डिस्ट्रीब्यूटर से खरीदा होता तो इसकी वैल्यू सिर्फ 80 रुपए होती. You got it? So it means it always better to buy directly because it will give you the highest return, because otherwise your return will get eroded. Okay, fine. What is the expense ratio of this fund?
0.74%.
Okay, so what is the normal, SEBI cap? 2.25 or something like that. Okay, so go to regular and see what is the expense ratio of this. Go. So if you would have put your money directly, what would have been the expense ratio?
1.5.
So what is the difference? How much is the difference?
Increase.
1.58 or 1.6 minus 0.74. So almost like 0.75% is going to the distributor. The difference is explain that how much money is going to the distributor every year. Have you got it? Okay. Now we have a break. It's 3:19, and then we'll do some more analysis as we go down and we can understand each and everything of the scheme. Okay. And it is 3:20. Okay. How much break do you want?
So 10 minutes.
Okay. 3:30 we meet again.